chapter 6. So I wanna make sure that we'll still have enough time for it, but I just wanna make sure that we've got enough, because it is such a big chapter, so we're gonna get started on that. What else do I wanna say? So I, on Thursdays, the first and third Thursdays of the month, I am going to have to leave here about 15 minutes early. I'm on a committee now that has a meeting that starts at 2:30 every other, first and Thursday month. So just kind of an FYI, and that starts this Thursday. Shouldn't be too much of a problem. We usually get everything wrapped up by then. I just wanted to make that announcement. Any questions before we get started? All right, you guys are doing great, by the way. I think I got everything, all the Tax Act stuff updated, and looks like you guys are plugging along. Excellent. All right. So I have to have notes for this particular section because I forget how this works, which is an indication for you that you may have to pay a little closer attention to how the charitable contributions work. So we're still talking about itemized deductions. And remember we talked about medical expenses, we talked about state and local income taxes, and we talked about interest, mortgage interest and investment interest, and how they are deductible on that as an itemized deduction. Charitable contributions are another one of those itemized deductions that we need to talk about. And this is a big area. And for a couple of years during COVID, they kind of had a special deal, if any of you filed taxes during then, where they actually allowed you a small amount of charitable contributions, cash charitable contributions, that you could deduct not as an itemized deduction, but right from your adjusted gross income on the front of the tax return. They don't do that anymore. It wasn't very much. It was like $250, $300, something like that. They did allow you to double it up if you were married, but it could only be cash contributions, and it was a way to try and encourage people to make contributions to charitable organizations. But like I said, that doesn't exist anymore. Now the only way that you get any type of tax benefit from a charitable contribution is if you itemize your deductions. Well, like everything else tax related, there are limits on the benefit that you can receive, or at least the current benefit that you can receive from charitable contributions. One of the things we need to talk about though is what exactly is a charitable contribution. I think I had mentioned before when I did the introduction to this chapter that it can come in cash, right? And that would be like cash or check or electronic transfer, Venmo, that kind of thing, anything dealing with cash. Or they could be non-cash. Non-cash could be goods that you own, think, donations to Goodwill, that sort of thing. But it could also be like stocks and bonds, things that have maybe some appreciated value, or investments, or land, houses, cars. People donate their cars to organizations and that sort of thing. So lots of different ways that people can donate, make those charitable contributions, but there are limits to who those contributions can be made to. It can't just be made to anybody. Like if you're generous enough to give some cash to the guy standing on at the entrance of the freeway because he's down on his luck, that's very kind of you, but that is not going to be a deductible charitable contribution. So what types of organizations, people, can those contributions be made to? And there's a list here of there's specifically 5 types of organizations that you can donate to. And notice that they are organizations, not individuals, right? That would be considered a gift, not a charitable contribution. So as a gift, you wouldn't get any deduction for it, but it also wouldn't be taxable to the individual that's receiving it. So any governmental unit or subdivision of the U.S. or its possessions, as long as the gift is for exclusively public purposes, you can be generous enough to pay more in taxes if you want. You can send the IRS, the Treasury Department, more money than what they're asking for if you want, and that would be considered a charitable contribution, or state organizations as well and local organizations. So any nonprofit organization that's organized and operated for religious, charitable, scientific, literary, or educational purposes, or to foster international amateur sports competition, and is not disqualified from tax-exempt status under 501c3. I don't know if any of you have heard that term, 501c3. If you've ever made a donation to an organization and you got a receipt for it, or you got a letter at the end of the year, at the bottom it's going to probably say that it's a 501c3. That is the biggest category of charitable organizations, and that refers to the tax code that describes that type of organization. This is the one that we're most familiar with, are the organizations that fall under this 501c3 category. Also though, organizations of war veterans, as long as no individual, shareholder individual gets any type of benefits from it. Domestic fraternal society or association that uses the contribution for religious, charitable, scientific, or educational purposes. Think Lions clubs, Masons, Rotary, that sort of organization. This one's very specific. Cemetery company owned and operated exclusively for the benefit of its members. I guess the members are those who reside there permanently. I don't know. I don't know the details of that one. You can actually look up charitable organizations. All of their stuff has to be publicly available. So, and the IRS keeps a catalog of all of the organizations. So if you had any question about whether an organization qualifies, if you were making a donation to an organization and you wonder if it qualifies for a tax deduction, you can actually look that up on the IRS website, and there's a link to it there. So those are the only types of organizations that you can donate to and get a tax benefit. That doesn't mean you can't donate to other types of organizations or to individuals. You're just not going to get tax benefit for it. Okay. So, how much of those contributions are actually deductible? There are limits to how much can be deducted, and we've got some. What do I want to talk about? Yeah, I guess I should probably mention this too. So oftentimes, I would get clients who would ask about whether or not the value of their time could be considered a charitable donation. So they make, they go to the soup kitchen or whatever and hand out, Thanksgiving, they're there helping out. The value of time is not considered to be a charitable donation. Only the actual out-of-pocket expenses that are related to that. So like the mileage that is incurred in getting to the facility, or if you purchased any food to help out with that value of that food would be considered. Travel expenses can be included. So they give an example here of a taxpayer travels away from home overnight to attend a convention. As a representative of a charitable organization, they can deduct those related transportation and travel expenses if they aren't reimbursed to them. Also, meals and lodging would be included in that. If they have, so those expenses are deductible if they have significant duties throughout the course of the trip and no significant amount of personal recreation is attached to the trip. So here they've got an example of Kathy, who's a CPA. She's a supporter of the Boys and Girls Club. She compiles the monthly financial statements and prepares the Form 990 tax return for the club. She estimates that she spends about 20 hours a year working for the club. Her normal hourly rate is $100 per hour. Because this is her services and her time, she can't deduct it though, right? Even though the counter to that is if she were to charge them for it, that would be taxable income, right? Again, you got to have both sides of the equation here. Because there's no taxable income involved in that, she's not going to get a deduction for it. Any out-of-pocket expenses that she paid though would be considered deductible. So although expenses for that kind of thing would be, like if she paid for the filing fee for the 940, You know, you gotta pay a fee to these software companies to file a form. So, and she probably had to. If she paid for that herself, then that would be deductible because she's actually out the money for it. Okay. Excuse me. So, non-cash contributions. You have to determine what the value of those contributions is, right? If it's not in cash, is easy to determine what the value of cash is. $50 bill is worth $50, right? A check for $50 is worth $50. A Venmo of $50 is $50. But what about that car that you donated? You know, what about the bag of clothes that you donated to Goodwill? We've got to figure out what the value is of those items. So if it's, generally speaking, most of the other types of donations that are made are what's called capital gain property. Now, capital gain, maybe you've heard that term before. It's usually associated with stocks and bonds and things that have, you know, securities that have appreciated in value. But capital gain property is actually any personal item of property is considered capital gain property, or any investment. So personal items or investments are considered capital gain property. So that donation to Goodwill is considered to be capital gain property. That your personal vehicle, that's capital gain property. There are some instances where there might be what's called ordinary income property. These are items like inventory and accounts receivable. We call these different types of property because if you were to sell them, they would be taxed at different rates. We have capital gains rates and we have ordinary income rates. If you sell an item of inventory, say you're in the business of selling clothing and you sell some clothing, that's going to generate ordinary income for you. That is going to be taxed at ordinary tax rates. Whereas if you sell an investment, say you have some Microsoft stock and you sell it and it has increased in value, that amount of value increase is going to be considered a capital gain and is going to be taxed at different rates. Okay, so that's the distinction here when they talk about ordinary income property and capital gain property. It's because they're taxed at different rates. And because these items, if you were to sell them, would be taxed at different rates, if you were to donate them, there's a different treatment for it as well. So that's why we're making a distinction. So ordinary income property would be considered things like inventory and accounts receivable. We're going to get a little bit more into that when we get, well, next chapter we'll talk a bit about it, and then chapter 7 as well we're going to talk about it, because chapter 7 we're going to talk about sales of assets, okay? These are, think back to your balance sheet, those are assets. Those are items that are on the balance sheet. Generally speaking, if capital gain property is donated to a public charity, the amount of the donation is the property's fair market value. This can be really advantageous if you have assets that have increased in value. So if you purchased, let's say you purchased a piece of land. You purchased it for $10,000. And right now the fair market value of it is $100,000. If you were to sell that piece of land, you would have a gain of $90,000 that would be taxable. You'd have to pay tax on it. Okay? Now, you'd have to pay tax at the capital gains tax rates, which are preferable tax rates. They're lower tax rates, but still, you'd have a $90,000 gain if you sold it. Well, instead of selling it, you decide you're going to donate it. You're going to donate that land to an organization. You get a deduction for $100,000. You get to offset. So if you sold it, you'd have a $90,000 gain that you have to pay tax on. It would be at capital gain tax rate, so that would be preferable. It would be a lower tax rate, but you'd still have a gain that you'd have to pay tax on. But if you donate it instead, you're gonna now get a deduction from ordinary income of $100,000. That's a pretty good deal. That's kind of one of those, that's one of those areas where you're the taxpayer in the tax code where it's kind of not equal treatment. They're given a big benefit to the taxpayers to encourage those donations, right? Now you're offsetting $100,000 of ordinary income with that gain. So, capital gain property donated to a public charity, usually, generally, so it means there's exceptions, generally is going to be the fair market value of the item. So if you were to donate something like that, you'd want to get an appraisal, or it's something to substantiate what that donation value is. There is an exception with the contribution of tangible personal property. So what we're talking about here, this is personal property, anything that's not real estate. So that land example, that's real estate, that's real property, that's not gonna be necessarily one of the exceptions here. But if it's tangible personal property, think the car. There is a difference in treatment depending upon how the organization uses the property. If they take that car that you donated and they use it in their charitable purpose, so they use it, say it's Meals on Wheels, and they take the car and they actually use it for transporting meals, that's using it in their charitable purpose, then the donation is the fair market value of that vehicle. Whatever you would get at a sale would be the fair market value of it. However, if the purpose, what they do is they turn around and sell the car, and then they just use the cash that they get from the car. Now, it's not being used for the charitable purpose. In that case, what happens is you have to reduce the fair market value of that vehicle. You're gonna get a donation, you're gonna get a value that is less than, you're gonna get a charitable contribution deduction that is less than that fair market value. Okay, and I'll show you what that calculation is. So let's see if they've got a good example here. So if a sculpture, they've got a different example here. So if a sculpture is donated to a museum and is put on display for the public, that would be a related purpose. Then you'd use the fair market value, that's your donation. If, however, the museum sold the sculpture without displaying it and then used the funds for museum operations, that is an unrelated purpose, which would require this exception. So what happens is that you would subtract so if it's so again, related purpose, and this is tangible personal property. So related purpose, you use the fair market value. Unrelated purpose, such as them selling it, T-E-D purpose, it's the fair market value minus the fair market value minus the cost of the item, whatever you paid for it, whatever the basis is in that property. I know I use the term basis, you don't know what that means. Basis is essentially cost. So let's look at, so if we've got, let's go back to this land. Fair market value is $100,000. Cost is $10,000. Fair market value, we get a donation of $100,000. If it's for an unrelated purpose, though, 100,000 minus 100,000 minus 10,000. So $10,000 is $10,000. Essentially your cost. Not as good a deal. That's why if you've ever donated a car or something before, you usually have to wait until, if they're gonna sell it, you usually have to wait until they've sold it and they send you a statement saying how much they sold it for. Okay, so essentially usually what it ends up being is just the cost. So whatever you paid for it. So if you're gonna donate, you like it to be a related purpose, right? That you're gonna get the better, deal with that. So also another exception, if it's investment property and it's short term means it's been held for less than 1 year. You bought it in April, you sold it, or you donated it in December. Less than 1 year. Long term is 1 year or more, no, more than 1 year. So 1 year plus a day. This is up to a year. So held 1 year or less. In this case, the deduction is limited to the tax basis of the asset, which is essentially its cost. So in this case, $10,000. If it's short term. Donation of investment capital gain property is also subject to additional limitations depending on the type of organization. We're going to go through those limitations. Excuse me. All right, so we've got an example here of Kemba. Donated an old computer to Helping Hands Industries. Purchased it for personal use several years ago. It cost $1,500. The computer's fair market value at the date of donation was $400. Computer is a capital asset held for more than 1 year, so Kemba is going to deduct the $400 fair market value as a charitable contribution. So obviously the fair market value and the cost, that fair market value oftentimes, especially when you're talking about secondhand items, is going to be less than what your cost was. It has lost, it has depreciated in value. All right. When ordinary income property like the inventory and accounts receivable is donated, the deduction is limited to the tax basis of the property donated. Usually that's the cost of the property, because for inventory and accounts receivable, we're not, and this will make more sense when we get into the depreciation discussion with the next chapter. They're not depreciated items, but it would be the tax basis of the property in that case. All right, so we've got that limitation depending upon, as far as the value of the property donated, right? So we've talked about that, what the value of the property is going to be if we donate something. There are additional limitations based on adjusted gross income. Okay, so again, we're going back to adjusted gross income. Three of those, we have three main categories of limitations. There actually are some other percentages, but your book doesn't go into them. 60%, 30%, and 20%. For our purposes, for the most part, these are the ones that we're concerned about, 60% and 30%. This is percentage of AGI. So, for example, let's say we got that land, fair market value is $100,000. So our donation is $100,000, but our AGI is also $100,000. We multiply our AGI by 60%. Now, this year anyway, we are limited to $60,000 reduction on that land. Even though the donation value is $100,000, our limit this year is $60,000. So what happens next year, we actually get to carry forward to the future the amount that is left over for up to 5 years. Now, if we have, let's say we have, so this is 2023, 2024, our AGI, we have, and we'll assume we have no other donations. So what we have remaining here is 40,000, right? We can only take that. So we get to carry forward $40,000. Well, let's just say our AGI now is $10,000. And we're still limited to 60%. Now we get a $6,000 deduction, which we then will use. So now our remainder is $34,000. 2025, let's say our AGI is 20,000. 60%. 12,000 is our limit. We've got 34,000 here. So we use that up and we've got 22,000 left. And then we don't have any AGI. We've got 22,000 left. And we've gone through 4 years. Let's say we've got 10,000 in our last year. We've got, what do we have here? 16,000 left. That just goes away. We weren't able to absorb it. Okay? So we've got 5 years to use that up. If we don't use it up, it's gone. That's a carry forward. And you see that in other places in the tax code as well, where a deduction, if you don't get to take it this year, you can use it the next year. Sometimes there's carrybacks. So you have to amend your tax return, but you can go back to a prior year and absorb that amount. All right. So the 60% contribution, and they talked about that, so the 5 years, subject to the overall 60% limitation in those years. For each category of contributions, taxpayer has to deduct carryover contributions after deducting current contributions. So if we've made additional contributions in those years, we're going to deduct those first and then absorb anything that's left here. All right, so here we've got an example. Doris is a wealthy widow. She has $200,000 of AGI from various investments. If she makes 150, and this 60% category is for cash contributions and for non-related use contributions. You can also use it in another scenario, and there's an example here that goes through that. So Doris, $200,000 in AGI from investments. She makes a $150,000 cash donation to State University. Assuming no other donations, her deduction limit is $120,000, which is 60% of the $150,000. Excuse me, is that 60? Oh no, I'm sorry, 60% of her AGI, pardon me. So the remaining $30,000 is going to be carried forward to following years. So that's the 60% cash donations, essentially. It's pretty much is the biggest category, but also unrelated use, tangible personal property. 30% limitation will apply for long-term tangible capital gain property. Tangible, you can feel it, you can touch it. Okay. When long-term tangible capital gain property is contributed to a public charity, the property is not, the property is put to a related use. So before I said that 60% is for non-related use. This is for related use. sometimes you start to think, do they make this complicated just for the accounting students? Just like it's intentional, like they hate accounting students or something. I mean, there must be a reason for it. All right, so if it's put to a related use by the charity, the taxpayer can take a deduction for the asset's fair market value. However, it's limited to 30% of the AGI. So we've got Doris. Instead of $150,000 of cash, she is donating a cottage. Okay, it's in a marshland, and it's going to be used for research purposes at the university. So it's a related use. Okay, it says up here, it's put to a related use. Has a fair market value of $150,000. The university does use it for biology and zoology students. Doris's deduction this year is limited to $60,000 instead of $120,000 because it's because it's long-term tangible capital gain property. Now it's limited to $30,000. So she's only going to get to deduct $60,000 this year instead of that $120,000. The $90,000 is going to be carried forward to future years. I'm going to, after I'm done talking about this, I want to tell you about tax planning implications for a lot of this stuff. There is an exception though. If she chooses to reduce the fair market value by the capital gain, which was the calculation we did before. So she decides to use that calculation. She's essentially going to use the cost, right? She subtracts, uses that other calculation, then she can use the 60% rather than the 30%. This would be good if she doesn't think she's going to have income in the future to absorb that $90,000. Because even though she's going to have to reduce it by the long-term capital gain amount, so she's going to get a lower overall deduction, she's at least going to get to use it up this year. Then she gets to use the 60%. So here's another example, same facts. However, she's still going to donate this cottage. She elects to reduce the fair market value of the cottage by the amount of long-term capital gain that she would have recognized if she had sold the cottage. So pretend that she's selling it. What gain would she get? Okay. Her adjusted basis in the cottage, they're giving us is $70,000. Her charitable contribution would be $70,000. Remember I said that calculation actually ends up being what the cost is, right? So in this case though, she gets 60%, she can deduct 60% of her AGI instead of the 30%. So she got a $60,000 deduction last time in the other scenario. Now she can take 60% of her AGI, which is $120,000. She gets to take a $70,000 deduction. She gets more of a deduction this year, but what she's doing is she's giving up future deductions. That $90,000 carryover, she's giving that up. But maybe she's not going to have any income in the future. Maybe those investments are not going to, maybe they are used up. And she's not going to have anything to absorb this. So it's better in her case, if that's the case, it's better for her to take the $70,000 now and forego the future $90,000, which isn't going to be of any benefit to her anyway, than to take the $60,000 deduction currently and have that $90,000 hanging out there that she's never going to be able to use. If that makes sense? I know it's confusing. Like I said, I have to write it down to try and remember how it all works. So if it's unrelated to the organization's function, we've got another example for that. Same facts, same house or building. All right, now the university sells it. In this case, the deduction is limited to her adjusted basis in the cottage of $70,000, because the presumption is that the use of the property was unrelated to the university tax exempt purpose. In this case, she gets the 60% of AGI deduction. So this other example here, she's just choosing to take this route because she knows she's not going to use up those future deductions. Okay. There's also a 30% limitation to certain particular types of organizations. War veterans organizations, fraternal orders, cemetery companies, and some other private foundations they're just because they're in that organizational bucket. Any donation, doesn't matter whether it's cash or non-cash, is going to be limited to 30% of AGI. And again, be careful. The percentage is based on AGI, not on the contribution. Okay, it's easy to get that mixed up. The 20% limitation is a donation of capital gain property to a private foundation. So cash to a private foundation is 30%, but capital gain property donation is 20%. How we doing? Hanging in there? Okay. All right, so Samantha gave State College $4,500 for 30 season tickets for women's basketball and $10,000 to its athletic foundation for preferential seating, location, and parking. This is a new thing. So you don't get a charitable contribution for a payment to an educational institution if you receive any preferential benefit. This was a big change. I had a lot of clients who, what they do is they make a donation. In exchange, they get the opportunity to purchase season tickets. Like, there's no season tickets, but if you happen to donate $10,000, all of a sudden there's season tickets available. You used to be able to get a deduction for that $10,000 or whatever donation. You don't get a deduction for it anymore because you got preferential treatment. Okay? So, none of that's deductible. Okay, so what kind of substantiation do we need? It depends on how much the contribution is. So for cash, if you donate less than $250 in cash, and this is on a per donation basis, not in aggregate over the year. So $250 in cash or less than $250,000, you have to keep a canceled check, some sort of receipt from the organization, or some other written record to substantiate the deduction. So if you're putting $10 a week in the collection basket at church, you're not gonna be able to deduct that. If hopefully your purpose of doing that is not for the deduction, but you're not, of course, that's assuming that you even itemize your deductions. But you don't have any substantiation for it, right? If you write a check, however, and put it in, then you're gonna have some substantiation because you got a canceled check. So, 200, like I said, that's per individual donation. So in aggregate, so let's just say you go to church every week, 52 weeks, and you're putting $100 every week into the basket. Obviously, that's $5,200, so that's way over $250, but it doesn't matter because the individual contributions are $100. All you need is the canceled check. That's it. If, however, you make a single donation over $250, now you have to get a statement from the contributing organization. The onus of the bookkeeping and record keeping is on the organization, not on the taxpayer. So you'll see if you make, and churches will give you that anyway. Usually they know how much you've contributed, unless it's cash. They know how much you've contributed throughout the year, and then you get a statement at the end of the year for it. But other organizations as well. So if you made a contribution of a single contribution of more than $250, then they have to send you out a written statement saying that you did not receive any benefits from that contribution, and this is the value of the contribution. Okay. If you did receive any goods and services, they have to indicate what the value of that was, because then you subtract the value of that. So for example, say you donated to a raffle. You donated an item to a raffle, and in exchange for that donation, you got free entrance into the event. So you donate a $500 necklace to a raffle, and the event, if you bought tickets, the event would be $100, but you get free entrance. They have to subtract that $100 and indicate that on there, that you did receive something that had a value of $100. So your donation is $400. Your deductible donation is $400 in that event. Okay? And that's just an example there of that. Whoops. I already mentioned that. Okay. So this is the section on the Schedule A, right? Gifts by cash or check. So we've got it separated out: cash or check, or non-cash or check. Non-cash. Cash or check, you just put everything there. And of course, this substantiation, the documentation, you don't send it in with the tax return. But if you get audited, you have it, right? You keep it. Other than by cash or check, is listed on line 12. And you'll see, if you made any gift of $250 or more, that's where it'll tell you in the instructions, you gotta have this receipt. You must attach an additional form if this total is over $500. I'll show you the form. And then any carryover from a prior year, so if you couldn't absorb all of it, right, because of your AGI limitations, that amount would be listed there. This is the 8283 that they were referring to. Hold on just a second. There are a couple of parts to this. Section A, donated property of $5,000 or less and publicly traded securities that were donated. If it's $5,000 or less, you list the name of the address of the organization. If it was a vehicle, there's a spot for the VIN. You got to put the VIN number here, and a description of the condition of the donated property. If it's a vehicle, year, make, model, and mileage. Then down here, this line A continues down here. The date of the contribution, the date that you purchased it or acquired it, how it was acquired. Did you buy it? Was it a gift? Did you inherit it? How did you get it? Your adjusted cost or basis, fair market value, and then how did you determine the fair market value? For any of you who've ever deducted like goodwill stuff, this is usually, so date of contribution, date acquired, you can put various in there, because obviously if you're donating a whole bunch of stuff, it's how it was acquired. Purchase, cost, usually that's kind of an estimate, how much, because it's all in a bag, although, I mean, technically speaking, you're supposed to be specific about it, but fair market value, that again is usually an estimate, although nowadays, those organizations will have a list of values, like what they charge for these items, you know, like t-shirts, $6 or whatever. So if you keep track of the items and have a list of them, which you should, you can get pretty close to the fair market value. Method used to determine fair market value for that kind of thing, it would be like thrift shop value. Okay. But if it was an appraisal, you could put appraisal in there. How did you determine what the value of it was? Then we've got a section down here for donated property over $5,000. And by the way, your tax return problem, you do have one of these forms in your tax return problem. So, and it's just this top part here that's filled out. But this is, so donated property over $5,000, oftentimes you will need an appraisal. So a qualified appraisal is generally required for any of these items in this section. But same type of thing, how did you acquire it, all that stuff. Okay, so that's the form that gets filled out. Non-cash items, so same as for cash. Same as what we just talked about. Again, that limit for to fill that form out is any non-cash items that are over, in total, over $500. That one's different. That one is in aggregate, over 500. Questions?